Welcome back to the mid-July 2026 ABS Market Breakdown. If you're looking for real polymer market intelligence, you're in the right place. Right now, global demand is incredibly slow. Looking at the top-line data, it's easy to assume this sluggish momentum means a permanent buyer's market. That assumption makes sense when you see prices holding completely flat. In the US, ABS sits steady at 85 cents per pound, and over in China, it's locked right at 10,000 RMB per metric ton. This stability creates a difficult decision for procurement managers. Do you float along on just-in-time inventory to preserve your cash flow today, or do you start stockpiling now to protect yourself from a potential price spike in Q3? Relying solely on these flat global spot prices to plan your Q3 buys definitely keeps more cash on hand this month, but it also leaves your entire supply chain exposed to shifts in the macro environment. While global data points to a safe environment, treating spot prices as your only indicator leaves your operations highly vulnerable to incoming macroeconomic shocks that are already building. This dashboard breaks down our forecast pillars. On the left, global spot prices show flat numbers across the US, EU, and China. But on the right, warning signs are flashing in macro sectors, specifically crude oil and the USD to rupee exchange rate. This brings us to the core question we need to answer today. Will locking in your inventory right now yield a mathematically positive return on investment compared to waiting it out? To figure that out, we must calculate the impending cost pressures coming from those warning indicators. We need to measure the actual cost of inaction. Misreading these mixed signals and holding off on buying risks locking your operations out just before a heavy price spike destroys Q3 margins. Let's isolate those global spot prices first. For a cautious buyer, flat pricing across major markets looks extremely appealing. In both the US and China, the total lack of price movement is driven entirely by ample overseas supply. Producers simply have zero leverage right now to push prices higher. This stability creates a false sense of security. It is easy to look at a flat line and assume that if you just wait another week or two, prices will dip further. You can see that wait-and-see mindset in Europe. Regional converters are actively avoiding stocking up on new inventory, creating heavy bearish sentiment across the market. Because no one is buying, European producers had to drop their rates by 10 euros, bringing spot prices down to 1,990 euros per metric ton. However, a price drop in Europe does not translate to landed savings in Asian or Indian markets. High freight costs completely erase that 10 euro difference by the time the material actually arrives. The reality is that overseas suppliers have already squeezed their margins as tightly as possible given the current lack of demand. The global market has hit a hard floor. Waiting around for further spot price drops is a mathematical dead end that will yield zero additional savings. Those global ceilings meet a harsh reality when we look at localized dynamics in India. On the surface, buyers are seeing what looks like positive news regarding import offers. Overseas suppliers are actively quoting lower levels for ABS import cargoes. For shipments arriving in late July and early August, offers have dropped to roughly $1,550 per metric ton CIF India. This chart shows why lower offers are misleading. While the CIF spot price edges downward, a massive counterforce wipes out those gains, the sharply rising US dollar against the rupee. Look where it crosses the 97 rupee mark. This threshold applies immense pressure to import costs. When you run the math, the penalty of purchasing with a weakened rupee instantly erases any perceived savings you might have gained from that $1,550 CIF price drop. Then we have to account for the most volatile pillar in our analysis: escalating geopolitical tensions, putting heavy pressure on global energy supplies. The math here is rigid. As crude oil prices trend higher, upstream feedstock costs are forced to climb right alongside them. Higher feedstock costs flow directly into local ex-works pricing. Local polymer producers will have to lift their rates simply to protect their own operational margins. The Indian Customs Department has kept exchange rates steady at 95 rupees 20 paise for now, but that administrative pause cannot stop the underlying crude oil spike. Future local price hikes are unavoidable. This overarching macroeconomic pressure guarantees that local producers will lift their ex-works prices very soon, heavily penalizing any buyer who decides to delay their procurement. This ROI scorecard solves your dilemma. In scenario A, you buy spot now, securing the $1,550 CIS price but paying warehouse storage. In scenario B, waiting until mid-August avoids storage, but severe ex-works hikes and currency penalties push your total costs significantly higher. This is the true cost of waiting. Securing warehouse space today is definitively lower than the incoming feedstock penalty you will pay tomorrow. We are seeing strong purchasing activity right now because processors anticipate these exact metrics and are moving to protect margins. The math is undeniable. Executing bulk purchases at current rates is the only financially viable way to lock in material before ex-works hikes destroy profitability. Of course, this ROI math means nothing if your business lacks the cash flow. Not every manufacturing plant has the capital to execute bulk stockpiling. This chart maps your decision path. For converters with strong liquidity and warehouse space, your route is clear. Buy at current prices immediately, before local hikes happen. If you are a just-in-time buyer who cannot tie up capital, you must follow the alternate path. To survive the impending spike, you need to aggressively hedge your currency exposure against the 97 rupee dollar and lock in your local supplier contracts today. To automate your daily market monitoring, text the word PVC to +91 93746 24365 on WhatsApp. Our AI-powered bot will send you instant, data-backed reports. In a market of false bottoms and mixed signals, relying on real-time mathematical analysis and decisive action is the only way to protect your business.